What if the rules of business don't matter? If you know how to play the system. Donald Trump didn't win by following the textbook. He used leverage without owning, took risks without carrying all the downside, and stayed visible even when everything was falling apart. From billion-dollar real estate deals to turning his name into global power, and eventually the presidency, the pattern stayed consistent. This video breaks down 15 of the most outrageous and calculated moves behind that system. And stay till the end because the final bonus move shows how he turned pressure into his biggest advantage. In 2026, Donald Trump escalated conflict with Iran, moving beyond diplomacy into direct military and economic pressure. But the move wasn't just military, it targeted the Strait of Hormuz, one of the most critical oil routes in the world, responsible for a major share of global energy flow. By threatening and partially controlling that route, the US wasn't just confronting Iran, it was influencing global oil supply. That immediately pushed energy prices higher, disrupted supply chains, and forced global businesses into uncertainty. It was pressure applied at the economic choke point of the world. It was leveraging geography to influence global markets. When you control the bottleneck, you don't just fight an opponent, you affect everyone connected to the system. Early on, Trump wasn't just building properties, he started putting his name on them. Trump Tower, Trump Plaza, Trump Hotels. But it was a shift in business model. Instead of only making money from owning real estate, he began licensing the Trump brand to other developers. They built the projects, and he provides name, marketing, and perceived prestige. That meant lower capital risk with continued upside. If the project succeeded, he earned fees and visibility. If it failed, his financial exposure was limited compared to full ownership. It was turning identity into a monetizable brand. In the early 1990s, Trump's casino and hotel businesses were heavily leveraged. When the market turned, the debt became unsustainable. Trump used it. Through multiple corporate bankruptcies, he renegotiated debt, reduced obligations, and kept control of key assets. Lenders took losses, but they also had incentive to keep the business alive rather than force total collapse. The system allowed him to restructure without being personally wiped out. It was using legal structure to absorb it. When deals are large enough, bankruptcy isn't always the end. Sometimes it's a reset button. When Trump developed Trump Tower in the early 1980s, he wasn't waiting for the building to be finished before making money. Before construction was complete, units were marketed aggressively using luxury positioning, celebrity association, and media coverage. The building was framed as a symbol of status, not just a place to live. People weren't buying square footage. They were buying into a narrative that allowed Trump to secure deposits and commitments before the asset was fully built. That early cash reduced financing pressure and validated demand publicly. If the project slowed, he already had buyers locked in. If it accelerated, he benefited from momentum he created himself. It was monetizing demand before delivery. Before launching major projects, Trump made sure one thing was already in place: attention. Through constant media appearances, interviews, and controversial statements, he kept his name circulating in newspapers, television, and public conversation. This wasn't random visibility, it was consistent positioning. So when a new project launched, awareness already existed. He didn't need to introduce himself to the market already knew him. Instead of spending heavily to get noticed, he entered deals with built-in visibility. The tactic wasn't just using media. It was front-loading attention before monetization. One of Trump's earliest major projects was the redevelopment of the Commodore Hotel in New York. The building was losing money. The area was declining, and lenders weren't eager to take on the risk. Trump didn't. He negotiated a long-term tax abatement from the city, significantly reducing the project's costs. Then he partnered with Hyatt to bring credibility and secure financing. Lower taxes improved margins. The hotel brand increased trust. Financing became possible. What looked like a bad deal became viable through structure. The tactic wasn't finding a perfect opportunity, it was reshaping the economics until the deal made sense. After taking heavy financial hits in the early 1990s, Trump changed how he expanded. Instead of putting his own capital into every new project, he shifted to licensing the Trump name to developers across different markets. These developers funded construction and carried most of the financial risk, while Trump provided the brand, positioning, and perceived prestige. This allowed him to be involved in multiple high-value projects without locking up large amounts of capital in any single deal. If a project succeeded, he earned fees and strengthened global brand recognition. If it struggled, the downside didn't hit him the same way it would under full ownership. It was expanding influence without tying up capital. As Trump moved into larger real estate projects, he didn't rely on fully owning assets with his own money. He used debt aggressively to control properties that were far larger than what his personal capital alone could support. Banks financed significant portions of his deals because the projects themselves had potential upside. As long as the asset value held or increased, the structure worked in his favor. He controlled high-value properties while putting in a fraction of the total cost. And if the deal succeeded, returns were multiplied because he controlled a large asset with limited equity. If it failed, the debt pressure became severe, which is exactly what happened during downturns. It was using leverage to access scale early. In the early 1990s, Trump's business was under real pressure. Banks had already lent him massive amounts of money. If he went down, they took major losses. That gave him leverage. He negotiated restructures, extended timelines, and in some cases reduced obligations while still staying involved in key assets. He wasn't negotiating from strength. He was negotiating from consequence. It was using pressure to force better terms. Long before social media, Trump understood something most businessmen ignored. Attention itself could be used as leverage. He stayed constantly visible. Interviews, bold statements, public appearances, controversies, all of it kept his name in circulation. It wasn't random. When he launched a project, he wasn't starting from zero. The media was already watching, investors were already aware. He used it to amplify every deal he touched. And if you want the final bonus move, the one that ties everything together and shows how he turned attention into his most powerful asset, make sure you're subscribed and stick till the end. As Trump's real estate portfolio grew, he made a shift that most developers don't. He stopped selling just buildings and started selling himself. They were buying into a perception of status, luxury, and success tied to his identity. That changed how deals were structured. Developers and investors didn't just evaluate the asset, they evaluated the impact of the name. In many cases, Trump didn't need to fully fund or even fully own the project. His involvement alone increased perceived value, which made deals easier to finance and market. At multiple points in his career, Trump's businesses were under serious financial pressure. But instead of stepping away, he stayed in. The reason was structure. Much of the debt was tied to the properties, not directly to him as an individual. When assets struggled, lenders were forced to make a decision: take control and absorb heavy losses, or restructure the deal and keep the business alive. That allowed Trump to extend timelines, renegotiate terms, and maintain involvement in key assets even during downturns. By the early 2000s, Trump's real estate empire had gone through multiple restructurings, and his public image was no longer just developer. It was inconsistent. Then came The Apprentice. Instead of treating television as entertainment, Trump used it as repositioning. Every episode reinforced a specific narrative: decisive, wealthy, in control. Boardroom scenes, Catchphrases like, "You're fired." That perception had direct business impact. His name regained strength. New licensing deals followed. Speaking engagements increased. Real estate branding opportunities expanded again because the market now saw a stronger version of the same identity. The show wasn't just content. He wasn't rebuilding through assets first, then converting that attention back into business opportunities. In the mid-1990s, after a series of struggling projects and heavy debt, Trump reported massive financial losses, casinos under pressure, properties underperforming, debt stacking up. But those losses created something else. They could be carried forward. Under U.S. tax rules, large losses can be used to offset future income. That meant when new deals started generating profit again, a significant portion of that income could be shielded from taxation. What looked like failure on paper became a financial buffer for future growth. Instead of starting from zero after a downturn, he moved forward with reduced tax pressure, allowing more capital to stay inside the system and be reused across new deals. When less money leaves the system in taxes, more stays available for reinvestment. That compounds over time. New projects can be funded faster, risks can be taken more aggressively, and recovery accelerates. It was about structuring recovery so that when momentum returned, more of the upside stayed in play. By the time Trump entered politics, he wasn't just a businessman, he was a brand with decades of built-in recognition. Most candidates build visibility during a campaign. He started with it. The audience already knew the name, the persona, and the tone. He applied the same playbook from business. Control attention, whether positive or negative, visibility stayed high, and that visibility translated into influence. What began as business branding extended into political capital. It was transferring attention from one domain into another and converting it into power. You made it this far. Here's the most ruthless move that ties everything together. Trump faced criticism, backlash, lawsuits, and negative headlines that would normally force most businessmen to step back and go quiet. When he didn't, and he stayed in the spotlight. Instead of treating controversy as damage, he treated it as fuel. News cycles kept repeating his name. Every reaction created more coverage. Every headline extended reach. The conversation never fully moved on. Constant visibility without paying for it. Whether people agreed or disagreed didn't change the outcome. Attention stayed locked, and when attention stays locked, every business move, every announcement, every deal travels further. Media exposure fed brand recognition. Brand recognition fed opportunities. Opportunities fed more exposure. The tactic wasn't controlling the narrative perfectly.
And there you have it, 15 moves that weren't built on traditional business rules, but on leverage, positioning, and control. Donald Trump didn't just build properties. He structured deals, shifted risk, used debt, monetized his name, and turned attention into a constant advantage. Some of these moves created massive upside. Others created controversy, but the pattern stayed consistent. Control the narrative, control the structure, stay in the game. This is Built Different, where we break down the real mechanics behind power, money, and influence. If you want more breakdowns like this, subscribe. Study the structure. Understand the leverage. Build different.